Welcome to our exploration of brand equity. In today's world, brands are more than just names or logos. They represent a set of values, promises, and experiences that shape how customers perceive products and services. Brand equity is the value that a brand adds to a product, going beyond its functional benefits. This value is built over time through reputation, recognition, and customer loyalty. When a brand has strong equity, it can command higher prices, foster customer trust, and create lasting relationships. Let's dive deeper into what makes brand equity so powerful and why it matters for businesses of all sizes. Brand's reputation is one of the most critical components of brand equity. Reputation is built through consistent quality, ethical practices, and positive customer experiences. When customers trust a brand, they're more likely to choose its products over competitors, even if alternatives are available. This trust can take years to develop but can be lost quickly if the brand fails to meet expectation. Companies invest heavily in maintaining their reputation because it directly impacts their ability to attract and retain loyal customers. A strong reputation is the foundation upon which brand equity is built. And recognition is another pillar of brand equity. When people can easily identify a brand by its logo, colors, or slogan, it creates a sense of familiarity and trust. Think about the brands you recognize instantly. This recognition often leads to preference and loyalty. Companies work hard to ensure their branding is consistent across all touchpoints, from packaging to advertising. The more recognizable a brand is, the more likely customers are to choose it, even in crowded markets. Recognition helps brands stand out and reinforces their value in the minds of consumers. Customer loyalty is the result of positive experiences and satisfaction with a brand. Loyal customers are more likely to make repeat purchases and recommend the brand to others. This loyalty doesn't happen overnight. It is earned through delivering on promises, providing excellent service, and consistently meeting or exceeding expectations. Brands with high customer loyalty enjoy a competitive advantage, as their customers are less likely to switch to competitors. Loyalty programs, personalized experiences, and strong customer support all contribute to building this essential aspect of brand equity. Trust is at the heart of brand equity. When customers trust a brand, they feel confident in their purchases and are more likely to remain loyal. Trust is built through transparency, reliability, and consistent delivery of quality. Brands that communicate openly and address customer concerns quickly are more likely to earn and maintain trust. This trust translates into long-term relationships and can even help brands recover from setbacks. Ultimately, trust is what turns first-time buyers into lifelong customers. Brands that evoke strong emotions create deeper connections with their customers. Emotional branding goes beyond functional benefits and taps into feelings like happiness, nostalgia, or excitement. When customers associate positive emotions with a brand, they're more likely to become advocates and share their experiences with others. These emotional connections are a powerful driver of brand equity, as they foster loyalty and differentiate the brand in a crowded marketplace. Successful brands understand the importance of connecting with customers on an emotional level. One of the key benefits of strong brand equity is the ability to command premium prices. Customers are often willing to pay more for products from brands they trust and admire. This pricing power comes from the perceived value that the brand adds, which goes beyond the product's basic features. Brands with high equity can maintain higher profit margins and invest more in innovation and customer experience. Premium pricing is a clear indicator of the value that brand equity brings to a business. Brand equity provides a significant competitive advantage in the marketplace. Brands with strong equity are more resilient to competition and market changes. Their loyal customer base acts as a buffer against new entrants and price wars. Additionally, strong brands can expand into new markets or product categories more easily, leveraging their reputation and recognition. This advantage helps businesses sustain growth and remain relevant over time, even as trends and consumer preferences evolve. Brands with high equity can successfully launch new products or services under the same brand name. This strategy, known as brand extension, relies on the trust and recognition already established with customers. When a brand introduces a new offering, customers are more likely to try it because they associate it with the positive qualities of the original brand. Successful brand extensions can drive growth and increase the overall value of the brand, but they must align with the brand's core values and reputation. Brands with strong equity are better equipped to weather crises or negative publicity. Their established reputation and loyal customer base provide a cushion during challenging times. Customers are more likely to forgive mistakes and continue supporting the brand if they have a history of positive experiences. Effective crisis management and transparent communication are essential for maintaining brand equity during difficult periods. Resilient brands can emerge from crises even stronger, reinforcing their value in the eyes of consumers. And advocates are loyal customers who actively promote and recommend a brand to others. These advocates are invaluable assets, as their word-of-mouth recommendations carry significant weight. Brands with high equity often have a strong community of advocates who share their positive experiences online and offline. Encouraging advocacy through exceptional service, rewards, and engagement can amplify a brand's reach and reputation. Advocacy is a testament to the strength of brand equity and its impact on business growth. It's important to distinguish between brand equity and brand value. Brand equity refers to the intangible assets created by reputation, recognition, and loyalty. Brand value, on the other hand, is the financial worth of the brand as an asset. While equity drives value, they are not the same. Companies measure brand value through financial metrics, but brand equity is built through customer perceptions and experiences. Both are crucial for long-term business success. Measuring brand equity can be challenging, as it involves both quantitative and qualitative factors. Companies often use surveys, brand tracking studies, and customer feedback to assess recognition, loyalty, and perceptions. Financial performance, market share, and pricing power are also indicators of strong brand equity. By regularly measuring these factors, businesses can identify strengths and areas for improvement, ensuring their brand remains competitive and valuable. Building brand equity is a long-term process that requires consistent effort and investment. It starts with delivering high-quality products and services that meet customer needs. Effective marketing, clear communication, and memorable branding all contribute to building equity. Engaging with customers, listening to their feedback, and adapting to their preferences are also essential. Over time, these efforts create a strong, positive reputation that drives loyalty and growth. Consistency across all brand touchpoints is vital for building and maintaining brand equity. This includes visual identity, messaging, customer service, and product quality. When customers have consistent experiences with a brand, they develop trust and confidence. Inconsistent branding can confuse customers and weaken equity. Brands that prioritize consistency are more likely to build lasting relationships and enjoy the benefits of strong equity. Storytelling is a powerful tool for building brand equity. Brands that tell compelling stories connect with customers on a deeper level, making their messages more memorable and impactful. Stories can communicate a brand's values, mission, and personality, helping customers relate to the brand. Effective storytelling differentiates brands from competitors and creates emotional bonds that drive loyalty and advocacy. Every brand has a unique personality that shapes how it is perceived by customers. This personality is expressed through tone of voice, visual style, and customer interactions. Brands with strong, consistent personalities are more memorable and relatable. Whether a brand is seen as friendly, innovative, or trustworthy, its personality plays a crucial role in building equity and attracting loyal customers. Customer experience is at the core of brand equity. Every interaction from browsing a website to receiving customer support shapes how customers feel about a brand. Positive experiences build trust and loyalty, while negative ones can damage equity. Brands that prioritize customer experience invest in training, technology, and processes to ensure every touchpoint meets or exceeds expectations. A great customer experience is a key driver of brand equity. Innovation plays a significant role in building and maintaining brand equity. Brands that continuously improve their products, services, and processes stay relevant and meet changing customer needs. Innovation demonstrates a commitment to excellence and keeps customers engaged. Brands known for innovation often enjoy higher equity, as customers associate them with progress and leadership in their industry. The digital age has transformed how brands build and maintain equity. Online reviews, social media, and digital marketing provide new opportunities and challenges. Brands must be proactive in managing their online presence and engaging with customers across digital channels. Transparency, responsiveness, and authenticity are more important than ever. Brands that adapt to the digital landscape can strengthen their equity and reach wider audiences. Social media has a profound impact on brand equity. It allows brands to connect with customers in real time, share stories, and respond to feedback. Positive interactions on social platforms can enhance reputation and loyalty, while negative experiences can spread quickly. Brands that use social media effectively build stronger relationships and increase their equity. Engaging content, timely responses, and authentic communication are key to success. Brand's culture influences its equity by shaping how employees and customers perceive the brand. Strong internal culture aligns employees with the brand's values and mission, resulting in better customer experiences. When employees are engaged and motivated, they become brand ambassadors, reinforcing the brand's reputation. Culture-driven brands often enjoy higher equity and greater customer loyalty. Strategic partnerships can enhance brand equity by expanding reach and credibility. When brands collaborate with trusted partners, they benefit from shared audiences and positive associations. Partnerships must align with the brand's values and reputation to be effective. Successful collaborations can introduce brands to new markets, strengthen their position, and increase overall equity. Corporate social responsibility (CSR) initiatives contribute to brand equity by demonstrating a brand's commitment to social and environmental causes. Customers increasingly expect brands to act responsibly and make a positive impact. Brands that invest in CSR build goodwill, trust, and loyalty, all of which enhance equity. Authentic and transparent CSR efforts are essential for long-term success. Engaged employees are vital to building and maintaining brand equity. When employees believe in the brand's mission and values, they deliver better customer experiences and act as brand ambassadors. Investing in employee training, recognition, and well-being fosters engagement and loyalty. Brands with engaged teams are more likely to build strong equity and achieve long-term success. Listening to customer feedback is essential for maintaining and growing brand equity. Feedback provides valuable insights into customer needs, preferences, and pain points. Brands that act on feedback demonstrate that they value their customers, which builds trust and loyalty. Regularly collecting and responding to feedback helps brands stay relevant and competitive. Innovation is a key driver of brand equity. Brands that continually introduce new products, services, or experiences stay ahead of the competition and meet evolving customer needs. Innovation signals a commitment to progress and excellence, which enhances reputation and loyalty. Brands known for innovation often enjoy higher equity and stronger market positions. Differentiation is essential for building brand equity. Brands that stand out from competitors through unique offerings, messaging, or experiences are more memorable and attractive to customers. Differentiation helps brands carve out a distinct position in the market, making it easier to build recognition, loyalty, and advocacy. Strong differentiation is a hallmark of brands with high equity. Exceptional customer service is a cornerstone of brand equity. Brands that go above and beyond to meet customer needs create positive experiences that foster loyalty and advocacy. Responsive, helpful, and friendly service differentiates brands and builds lasting relationships. Investing in customer service training and resources pays off in the form of stronger equity and business growth. Strong visual identity is crucial for building brand equity. Logos, colors, typography, and design elements all contribute to how a brand is perceived. Consistent and memorable visual identity helps customers recognize and remember the brand. Investing in professional design and maintaining visual consistency across all channels reinforces equity and strengthens the brand's position. Effective communication is key to building and maintaining brand equity. Clear, consistent, and authentic messaging helps customers understand what the brand stands for. Communication includes advertising, public relations, social media, and customer interactions. Brands that communicate well build trust, loyalty, and positive perceptions, all of which contribute to strong equity. Building strong relationships with customers is essential for brand equity. Relationships are built through trust, communication, and delivering value. Brands that invest in relationship-building activities such as loyalty programs and personalized experiences create deeper connections with customers. These relationships drive repeat business, advocacy, and long-term success. Brands' position in the market reflects its equity. Brands with high equity are often seen as leaders or innovators in their industry. Market position is influenced by reputation, recognition, and customer loyalty. Brands that consistently deliver value and differentiate themselves are more likely to achieve and maintain strong market positions. Brand equity is a key driver of business growth. Brands with strong equity attract new customers, retain existing ones, and expand into new markets more easily. Growth is fueled by positive reputation, recognition, and loyalty. Investing in brand equity pays off in the form of increased sales, market share, and profitability. Profitability is closely linked to brand equity. Brands with high equity can command premium prices, enjoy higher margins, and reduce marketing costs through word of mouth and loyalty. Profitability enables brands to invest in innovation, customer experience, and growth initiatives. Strong equity creates a virtuous cycle of profitability and reinvestment. Brand equity acts as a buffer against risks such as market downturns, competition, or negative publicity. Brands with strong equity are more resilient and can recover more quickly from setbacks. Risk management strategies such as crisis communication and reputation monitoring help protect and preserve equity. Proactive risk management ensures long-term brand health. Strong brand equity makes it easier to acquire new customers. Positive reputation, recognition, and advocacy attract potential customers and reduce the need for aggressive marketing. Brands with high equity benefit from referrals and word of mouth, which are more effective and cost-efficient than traditional advertising. Customer acquisition is a natural outcome of strong equity. Customer retention is a key benefit of brand equity. Loyal customers are less likely to switch to competitors and more likely to make repeat purchases. Retention is driven by trust, satisfaction, and positive experiences. Brands that focus on retention enjoy higher lifetime value from their customers and more stable revenue streams. Word of mouth is a powerful driver of brand equity. Satisfied customers share their positive experiences with friends, family, and online communities. This organic promotion builds reputation, attracts new customers, and reinforces loyalty. Brands that encourage and reward word-of-mouth advocacy strengthen their equity and expand their reach. Brands with high equity often enjoy larger market shares. Their reputation, recognition, and loyalty give them an edge over competitors. Market share is a reflection of a brand's strength and influence in its industry. Brands that consistently deliver value and maintain strong equity are more likely to lead their markets. Brand equity facilitates business expansion into new markets or product categories. Established reputation and recognition make it easier to gain acceptance and trust in new areas. Brands with strong equity can leverage their existing customer base and brand associations to drive successful expansion. Expansion is a natural progression for brands with high equity. Investors value brands with strong equity because they are more likely to deliver stable returns and growth. Brand equity is an intangible asset that enhances a company's overall value. Companies with high equity attract more investment, enjoy better financing terms, and have greater flexibility to pursue new opportunities. Investing in brand equity is a smart long-term strategy. Brand equity plays a significant role in mergers and acquisitions. Companies with strong brands are more attractive targets and can command higher valuations. Merging brands with high equity can create synergies, expand market reach, and drive growth. Careful integration is essential to preserve and enhance equity during mergers. Brand equity contributes to a brand's legacy and long-term success. Brands with strong equity are remembered and respected for generations. Legacy is built through consistent delivery of value, positive experiences, and meaningful contributions to society. Brands that focus on building equity leave a lasting impact and inspire future generations. As markets evolve and customer expectations change, brand equity will remain a critical asset for businesses. Brands that adapt, innovate, and stay true to their values will continue to build and sustain equity. The future belongs to brands that prioritize customer relationships, deliver exceptional experiences, and make a positive impact. By investing in brand equity today, businesses can secure long-term success and growth.